Is another Penny webinar episode. I'm Charles King, your advanced case design specialist. And today we are going to talk about MYGAs. We're going to talk about multi-year guaranteed annuities and the reason why we're seeing a lot of market volatility. A lot of our pre-retiree clients want to seek stability, obtainable and easy to understand outcomes and how they can kind of secure their retirement or non-retirement funds in a modality that's not going to throw them any surprises or having them ride the roller coasters and the ups and downs of the markets. So we're brought to you by Penny. We are serviced by the illustrious Penny A team. I will do a brief blurb on that, and then we'll jump into the content. So why did we build the Penny A team? Life insurance opportunities rarely disappear because clients lack interest or because solutions aren't appropriate. More often, strong cases slow down or fall apart due to the operational demands required to move them from conversation to placement. Gathering client information, completing applications, managing requirements, coordinating underwriting, and maintaining follow-up can quickly become overwhelming. Even highly successful producers often find themselves pulled away from revenue-generating activities just to keep cases moving forward. When follow-up becomes inconsistent or timelines stretch too long, momentum can fade. Clients become distracted, decisions are delayed, and opportunities that should have resulted in placed business quickly are lost due to the process rather than the strategy. The solution is the Penny A team. The Penny A team is a dedicated group of specialists designed to function as an operational extension of your practice. Once you identify an opportunity and make a warm introduction, the A team helps manage the implementation process from start to finish. This includes guiding the client through an application process, coordinated underwriting, and supporting the path to policy approval and delivery. So, how does the A team support your business? We assist with and help lead client conversations when needed to ensure clarity and professionalism, manage application completion and documentation requirements to reduce administrative burden, coordinate with carriers and underwriting teams through an experienced case management group with 45 plus years of combined experience. We track requirements, monitor progress, and maintain consistent communication throughout the underwriting process. Proactively follow up to keep cases moving forward towards approval and placement. What this means for you as the agent, you're going to spend less time managing paperwork, requirements, carrier communication. You'll be able to stay focused on the highest value activities, building relationships, advising clients, and identifying new opportunities. You'll maintain full ownership of the client relationship while the operational team works behind the scenes on your behalf. Will improve case momentum, placement rates, and overall client experience, and help you scale production without hiring additional internal staff or increasing operational complexity or bandwidth or having to hire more people. So the goal is we want to help agents place more business, create a smoother experience for clients, and enable advisors to scale their practice efficiently and sustainably. So without any further ado, guys, we're going to jump into the material. So a lot of people nowadays are asking about, hey, what are MYGAs? What's a multi-year guaranteed annuity? Why would I do this? And which ones would I go with? Well, let me tell you, as we kind of see the Fed chair and the open chairs of the Federal Committee, they're going to start hiking rates a little bit to combat inflation. Why is this good news? Well, it might kind of cause a little bit of tizzy with markets, might cause a little bit of a tizzy with bond markets to some extent, but typically higher interest rate yields are going to mean that MYGAs and FIAs and other fixed annuity products are going to pay you a little bit more, maybe 25 basis points, maybe 50 basis points. The reason why multi-year guaranteed annuities are so popular right now is they give you a sustainable and a repeatable year-over-year return that is not going to throw you any surprises. What you see is what you get. A lot of pre-retirees are getting close to that period. They've kind of gone through their accumulation phase. They have a retirement date. They want to be able to kind of project what they're going to see. They don't need the surprises. They don't need the roller coaster ride of the ups and downs of the market. They just need it to work as advertised. And multi-year guaranteed annuities really do a great job of holding that space. So we'll go over today, understanding what a MYGA is. what are the top carriers and positioning strategies? And what are some of the product comparisons, features, and sales opportunities? We'll move on to the next slide. We did already kind of brief, but just for a recap, the Penny 18, we are standing by, ready to help you with your annuity business, whether it be a FIA or a MYGA or a fixed annuity. Here's a testimonial from one of our great fans and who runs a great podcast, that's industry-wide and in-zone-wide. Love working with Cyrus. Absolutely great guy with a great program. I love to tune into his stuff as well. And our disclosure. So, attention. This material is provided for educational and informational purposes only and is not intended as and should not be relied upon as tax, legal, or financial advice. Your situation and scenario matters. You should consult with a qualified tax advisor, attorney, or financial professional, or all three, regarding your specific situation before making any decisions. The strategies discussed may not be suitable for everyone and are subject to change based on laws, regulations, and definitely those individual financial circumstances of your client. So, why are MYGAs exploding in popularity? They are a perfect combination of safety, certainty, and now with some interest rate movement, competitive rates. These are driving them in unprecedented client demand. People want some certainty, especially as they're in that pre-retirement phase and are entering into that retirement phase where they're going to start to look at doing withdrawals. They want to make sure that they're doing that sustainably and that they're not going to get any surprises in the last 3, 5, 7 years before they end up picking their retirement date. So today's interest rate environment. Interest rates remain at levels we haven't seen in over a decade. A lot of what's happening right now with our open chair committees with the Fed, they are wanting to combat inflation. Well, the only way to kind of combat inflation is to kind of make sure that rates are up. Why do they do this? They do this because it can often restrict supply or restricts kind of the measures of how debt is handled. So what happens is CDs, MYGAs, FIAs, some bonds, municipal bonds, corporate bonds, etc., will often pay a higher nominal coupon rate to keep in match with Fed policy. Now, MYGAs are offering some of the most attractive guaranteed rates in years, and they're typically slated to get a little bit better. Our new Fed Chair, Kevin Warsh, wants to combat inflation by possibly raising rates to undo the last 20 years of quantitative easing. So clients want to lock in rates now before the market move. And you also see some of that, the rate happening as they hike up. We will see more competitive rates in the annuity space. And why clients are moving money. Well, CDs and saving accounts, they don't really offer as much of a return. And typically you are locked in at minimum for a year. There are no liquidity provisions without penalty, as well as they are only typically insured at the FDIC rate, which is $250,000 or $250,000. Clients want that safety without having to take the market risk, but they also want to see the upside of a fixed rate. MYGAs provide guaranteed growth, predictable returns, and peace of mind. Where is that opportunity for you? Well, right now, with high client interest and strong conversion potential, people are looking for some safety, but they also want a good mix of return. So position MYGAs as a foundational piece of a conservative strategy. Maybe if they have a large amount on their stock account, they need to kind of hedge and create a guaranteed return profile for at least a portion of their money to get to their retirement goals. How do we do this? By positioning MYGAs, we're able to give them that safety and certainty. It's going to build a stronger client relationship and increase that wallet share. So client demand is high. It won't last forever. If we start to see rates track down a little bit, you want to make sure that you lock those in at competitive rates. The MYGA does a great job of doing that. You get locked into a MYGA today or within the next 6 months as the rates are rising, You will still be in that interest rate profile even if rates start to track back down again. So you want to lock it in at the highest rate possible and then ride out your 3, 5, or 7 year term and get as much return as you can at a guaranteed rate. Moving on. So what is a MYGA? A MYGA, a multi-year guaranteed annuity. It's a fixed annuity that offers a guaranteed interest rate for a set of period of time, usually already predetermined at the contract rate when you sign it. There shouldn't be any surprises. You know exactly what you're going to get and how long the duration of the product is. Usually spans anywhere from 2 to 10 years. They are safe and secure. They're backed by the financial strength of the issuing insurance company. And even then, if they maybe are not rated A plus or A, they are still backed by the state insurance receivership accounts. So these are fairly safe vehicles. I would not say that they're, I'm not going to put them and say that they're as safe as CDs or treasuries. But they are very, very safe. They are something that you can rely on. They should not throw you any surprises whatsoever. Guaranteed growth. Your rate is locked in for the full guarantee period. No market risk. What you see is what you get. And it's that peace of mind the clients like because they know exactly what their money will earn and when. So how does it work? You'll invest. You'll make a premium payment into a MYGA. That rate is assigned an interest rate, and that interest rate is guaranteed for the selected term, whether it be 3, 5, 7, or 10. And then your money will grow at that rate, compounding at, let's say, we'll just throw a number out, 5%. It will compound out that for the predetermined period, whether it be 3, 5, or 7 years. At the end of the term, you have some options. Often at the end of the term, they will still put you in a 1% rate where you're still gaining some money, but at that point you have some options. You can either surrender and withdraw penalty free. You can roll over into annuity or into an IRA or some other modality, or you can renew the MYGA. And also, because it is an annuity, a lot of people don't know this, you can annuitize the MYGA at that rate. Once you annuitize, it can start and turn on payments for life. I've had a lot of agents that did not understand that a MYGA can be annuitized. Wanted to make sure that was concise and clear today. You don't always have to switch to another contract. If you're ready to take your retirement date at end of term, you absolutely can annuitize these contracts, and they'll give you a predictable payment for the rest of your life. Okay, so we'll kind of dive through the guaranteed illustrations. Say year 1 or year 0, you invest $100,000. Your guaranteed rate is locked in. Your money's going to grow tax deferred. It continues to grow throughout the term. If you get quoted at a rate for 5.5, you can expect without fail, you are going to get 5.5 every year. That's a very competitive interest rate. Typically on the investment side, we're looking to get anywhere from 7 to 8%. When you do that, something in play it's called the rule of 72. And what that is, typically from 7.5 to 8 years, if you're catching 7.5 to 8%, you're getting close to doubling your money. 5.5 is a great rate for a guaranteed instrument. So as you can see down here, where you would compound. So you start out with 100,000. Year 1, you're at 105.5. Year 2, you're at 111, 303. Year 3, 117, 420, and finally down to the end of term, 130,672 with no surprises, no roller coaster ride, and full certainty that what you see is what you're going to get. So they're fairly simple, guaranteed products. They do a great job to put you in the driver's seat and know exactly where you're going to be. Maybe take a little bit more risk in your stock account otherwise because you have that portion of guaranteed money that's going to behave the way you expect it to. So safety of a MYGA, we're going to kind of compare it to CDs. A lot of people are very risk averse. They like CDs. Nothing wrong with CDs. The only problem that I see, there are some pros and cons to both. Really, most of the cons that I see are, on the CD side. On the CD, they are FDIC. They are bank products. They are only insured up to $250,000. So if you are going to spread money over CDs, please do them in 250 or less denominations. So the MYGA is backed by the financial strength of highly rated insurance companies. Some of these companies have been around 110 years or more. They're not going anywhere. We've seen, companies like Mass Mutual, Northwestern, and other mutual companies. They've been around longer than many of us, and they'll probably be around longer than many of us will probably live in our lifetime. So the MYGA is backed by the financial strength of highly rated insurance companies. The CD is backed by FDIC insurance up to $250,000 per depositor. Growth is tax deferred until the withdrawal phase, and you have a potential for lower taxes in retirement. The CD interest is taxable annually as ordinary income. If you're in a high tax bracket, that might not be the greatest thing. Often what we see is on non-qualified money, we're looking to achieve a tax rate, the capital gains rate, which sometimes can be lower for those that are at a high income bracket. So the MYGA can also bypass probate and estate by named beneficiaries who receive the full value quickly and privately. If you pass away and there's a beneficiary on there, it does not have to be will and codiciled. It does not have to go through a probate court. It will go directly to your beneficiary. CDs, they're payable to the estate. There is no POD named. Beneficiaries may face delays or have to go through the probate process to receive their inheritance from that instrument. I think generally we already kind of talked about that, but generally transfers outside of probate, private and efficient. Once again, CD may be subject to probate. Another great thing about the MYGA, it's locked in, a guaranteed rate for the full term. You're not going to get any surprises. What you see on the duration as well as the interest rate, or what we call in the bond market a nominal coupon, there's not going to be any surprises. You're going to get exactly what you're expecting to get with a MYGA. For the CDs, fixed rate for the term, but typically lower than MYGA fees. They also can automatically renew at times, and you can get stuck with what we call opportunity cost by being stuck at a lower rate than you could have sought elsewhere. Another thing is you have more liquidity provisions with the MYGA. Let's say you get in a jam, you need to pull some money. Access the portion of your money each year, usually 10% penalty-free withdrawals. You will not be able to pull 10% with a CD. There usually is not any liquidity provisions, and if you do, that will often incur some sort of penalties that can reduce the principal. So, also you have the option on the MYGAs. You can choose to renew, roll over, receive payouts at the end of the term. You have multiple options in which you can handle the end of the duration of that product. CDs, typically you must renew or reinvest at that bank's current rates, and often they are going to be significantly lower than what you're going to see in the offerings of MYGAs. So MYGAs versus fixed index annuities. They are both great products, and fixed annuities does have fixed interest rates that you can rely on. They are usually not quite as competitive, maybe 25 basis points lower, 10 basis points lower here. Not as competitive as the MYGA rate, but they do give you the opportunity for a ceiling and a floor to where you can capture some market upside, giving you a little bit better return in a variable modality. So there is a chance that you could make a little bit more, or if the market's down, you could see zero growth in year 2, year 3, year 4, if the markets don't cooperate, and that's how your sub-accounts are set up. So on the MYGA, it's going to provide a very predictable guaranteed growth for a set period of time. Fixed index annuity, it can do both. If you're using just the fixed sub account, or if you're using the index account, it will provide a market linked growth with some downside protection for long-term accumulation. Usually you would run FIAs a little bit longer than MYGAs. The fixed guaranteed rate for the full term, higher rates for longer commitments. So typically, if you're in a 3 or a 5 or a 7, usually the longer the duration of the product, not always, but typically the longer the duration of the product, the higher the yield curve is going to be. If you can lock in money at 3 years, you might catch 4.8. Let's give you an example. 5 years, you might catch 5. 7 years, you might catch 5.25. 10 years, you might catch 5.5. So typically the longer duration, the kind of the steeper that yield curve is at the end of that product. On FIAs for the index sub accounts, those returns are not guaranteed. They are linked to an index, whether it be the Barclays, Ag Bond Index, or the S&P, or a real estate index. Typically, you're going to get a ceiling and floor. The cap's somewhere in between 8.5% to 10%. If the market's doing great, you can capture every bit of that. But if the market's kind of going on a roller coaster ride and is depressed, you can catch a lower amount. So it's not fully guaranteed. It is contingent on what the index is paying. As far as MYGA operates independently of market exposure. It runs off of the guaranteed interest rate at the time the contract is placed in force. So if rates go up tomorrow, we lock in a rate. We're getting 5.5, maybe 6. Interest rates go down 24 months later. We're still at that 5.5, 6 rate. That is not something that can always be guaranteed with an FIA or other products. There is some direct market risk, not to principal, but to your returns and your interest rates on the FIA side. So MYGAs and fixed annuities, most of them all have typical, 10% a year penalty-free withdrawals. Fixed index annuities can vary a little bit, but most of them also have the 10% withdrawal rates as well. There is a typical surrender charge period with those limited free withdrawals, but typically 10% is the industry standard for both products. MYGAs are great in terms of 2 to 10 years. They're really great for pre-retirees that need that certainty. Fixed index annuities give you if you have a longer rate, so you're going to run 8, 10, 12, 15 years. You usually have a better average to capture a higher growth amount with a market leaked index over time. It's called dollar cost averaging, where the market moves and money moves into it. So clients that are seeking safety, predictable growth, and short to intermediate term goals are often better served by a multi-year guaranteed annuity. Clients looking for market-leading growth that's has some downside protection for longer term goals, often better served by an FIA. So when does a MYGA make sense? You want a guaranteed rate for a set period. You have a specific timeline in between 2 to 10 years. You prefer certainty and minimal risk. You're saving for known future expenses or withdrawal rates, and you want to lock in today's attractive rates. It can be a great tool. When does a fixed index annuity make sense? You want a little bit more growth potential tied to the market. You have a longer time horizon, usually 5+ years. You want downside protection with some upside potential. You don't need full liquidity, and you're planning for retirement income or legacy, usually on a slightly longer timeline. You can also ladder these two products and build yourself something that gives you the best of both worlds. And they can run side by side and concurrent and often perform very, very well for pre-retirees. So who is the ideal MYGA client? MYGAs are designed for clients who value safety, certainty, and predictable growth for a specific period of time. If you're looking at people that typically do business in CDs, clients looking for better rates and safer alternative CDs, the MYGA is a great option. It's typically going to be your conservative investors, or those that have tranched off, a large amount of their allocation from the market to be in safe dollars that they can rely on when the rest of their stuff grows. People who have IRAs that are, nearing their withdrawal dates, and they need that certainty. Clients with maturing CDs, IRAs, retirement accounts, and they're seeking that safe tax-deferred home for their money. Keep it growing, keep it tax-deferred. MYGAs do a great job working there. For those that need to do something with cash and don't want to incur a large amount of capital gains or get kind of beat up at their higher tax bracket for income distributions, cash buyers are also great for MYGAs. Business owners that want something that they can park some excess cash or profit margins and grow it with some certainty, or even do some sort of supplemental employee retirement plan like a SERP, MYGAs and FIAs can serve that need. Probably more on the shorter term. MYGAs do a better job, and they kind of give you an idea of what that defined interest rate is going to be. The recently retired that just cannot bear the market risk up and down. They know what their costs are. They know what they need to survive, pay their medical bills, pay their house note, take care of everything, home and hearth. These people want some certainty. They don't need the ups and downs of the market affecting what they're able to do in their retirement. MYGAs do a great job at creating a smooth ride for buyers that are looking like that. Current MYGA market, okay, for 2026. Right now, we're sitting at some fairly competitive rates. 2 years, you're running anywhere from 4.25 to 4.75. 3 years, 4.6 to 5.25. The 5 year, running 4.9 to 5.6. 7 year durations running at 5 to 5.85, and 10 years can vary from anywhere from 4.85, and I've seen some lesser rated carriers pay all the way to 6 points. A lot of that competition is driving the value. Top rated carriers are competing aggressively on rates, features, and flexibility for your business, and the carrier is offering some of the highest rates in over a decade. So strong financials across the industry provide confidence, stability, and more flexible features to meet client needs with the free withdrawals, nursing home waivers, LTC riders, etc. And there's more choices now than there ever has been before as far as the annuity market. It's its whole universe. You have multiple flavors, but the MYGAs are kind of what we're seeing as the client preferred choice for the near-term retiree. So as far as sales opportunities, clients are looking for safety, certainty, and better returns. MYGAs are able to predictably do all three. So high client demand. CDs are maturing. Market volatility, economic uncertainty are all driving clients toward guaranteed solutions that aren't going to throw them any surprises. They want the ability to either convert or consolidate funds. These are something that you can use to help clients move from low yielding CDs and into savings accounts into higher nominal interest rates and higher yielding multi-year guaranteed annuities. They are perfect for laddering strategies. What we've seen with insurance and annuity planning is we put a MYGA on the front end 5 years and then have a laddered FIA running in concurrently at a 10-year rate. The MYGA is able to kind of supercharge the front end growth of those retirement assets or non-qualified assets. And they're also will create some ability for some cross-sell opportunities. You pair MYGAs with life insurance, other income annuities, estate planning, and spendthrift provisions for those that want to leave a legacy. They can be a complete solution that, once again, is predictable, sustainable, easy to understand and explain to your client, and easy to execute. So some of the top MYGA carriers. I've got some of my favorites on this list. I'll try to stay product and carrier agnostic. I have seen some great rates from Ocean View. I have clients in Ocean View. I think they do a great job as far as the contracts. They have industry-leading rates across multiple terms with a strong focus on client value and decent liquidity and bonus provisions. SILAC has had consistently high rates, flexible products backed by exceptional financial strength. F&G, kind of the same. Global Atlantic, Delaware Life, Symetra has some really cool features. Mass Mutual Ascends, one I've used concurrently for some laddered strategies and multiple clients that their scenarios met those goals. It's hard to find an insurance company that's been in business longer or is stronger than Mass Mutual Ascend. I would put them up there with the top rung. I'd also add Allianz and Nationwide to that list too. All do a great job. North American is very strong balance sheet, conservative company. They don't take a lot of risks. They're fairly competitive on their rates, and they are very reliable, simple chassis contracts. I would also throw Athene on there as well. Midland National is another solid rate provider. They are mostly direct to consumer, so you kind of deal with them on their own. but they are also kind of a mid-rated. They are a good company to work with. One of my favorites, I would say, is Corebridge. Corebridge has a myriad of different products, a strong balance sheet, innovative solutions, and I'm able to confidently use them in recommendations as well. Moving forward, some of the product terms here, and we'll give you some ratings. I will tell you, often with the lower ratings, you will see a higher rate of return. Even if it's guaranteed product, there isn't a major difference between an A++ rated carrier and an A- carrier. You will also see that some B rated products, don't let the B rating scare you away. Often we'll see B rated products are still fairly financial strong. They have decent balance sheets. They're well regulated and orchestrated by, the NAIC and insurance commissions, and they'll often pay a little bit more competitive rate for your faith and putting your business with them as well. All of these are going to give you that 10% free withdrawal for a year if you need it. Most of them are not, if not all of them, will give you some sort of either LTC rider or nursing home waiver. And they will also give you a death benefit that can transfer back to your beneficiary in a tax-free modality. Most of them, you'll see that their issue ages are 0 to 85. You will see a couple that it's, you'll find an 80 or an 81. Typically, we're looking at pre-retirees. Some people want to leave a legacy in their older age. MYGAs can also be very good for that. Product terms, like you said, most of them are going to range from 2 to 10 years. Some, 3 to 10 years. Typically, if you're buying a MYGA, you are looking to kind of stay in a safe modality for, 3 to 5 years. That's really the sweet spot. And moving forward, so on a deep dive, Ocean View, once I said, is a very competitive rate. They do a great job. They have a simple chassis that's easy to understand and put your clients in. They have client-friendly features. They are built for pre-retirees, and they focus on service. Really, where the best fit is, just like any of these, CD shoppers and people looking for higher returns with the same safety. They're looking for some guaranteed rates. We like to lead with rates. We only kind of deal in some of the top rated insurance companies. We have some that are B rated or not for those that are a little bit more competitive, but we are leading with rates. If we want to get you into a MYGA contract, we want you to have the best scenario outcome that we can possibly provide. Global Atlantic, attractive rates across the board. Another one I think is, I have no reservations about, recommending any of these. They do a great job. A lot of them, once again, client-focused features. They are practically built for pre-retirees and legacy products. We will see a lot of advisors and CFPs that are willing to section some of the risk or standard deviation out of their stock accounts and put pre-retirees into these to balance out that portfolio allocation and provide some guarantees and peace of mind to those pre-retirees. F&G also does a great job. They have great financial strength, great balance sheet control, and a myriad of products. I won't go into all of the features on all of these, but most of them are fairly synonymous. We really lead on who's going to pay the best rate with the simple, easiest to understand contract. That way our clients know exactly what they're going to get when they sign on that line and invest their money with us. Silac, another very competitive. They've done a great job on keeping competitive rates. And once again, a lot of these features are synonymous with the entire industry. What's offered at another, there might be some slight variation, but most of them keep pace with each other to stay competitive in the market. And finally, laddering MYGAs, 3, 5 year, and 7 years. Let's say you want to short-term access a higher interest rate, your best near-term opportunities and peace of mind. You're going to lock in a competitive rate at 3 years. Maybe it will run concurrently with a 5-year MYGA and a 7-year MYGA. What this does is, let's say you can get 4.5, and then some of that money will become fully liquid at year 3. And then you're still growing at 5.5 for your 5-year, and then that money becomes liquid at year 5, and then 7 years. Let's say you get a better rate, maybe 5.25, maybe 5.5, and then finally at the end of the 7-year term, the the latter third of your money will become liquid, all at different interest rates or slightly varied rates. Why would you do this? The reason why is if you can lock up a portion of your money with the rate that you need, you can also lock up the money, on a 5-year or 7-year at some different rates. It gives you a little bit of diversification as far as returns are concerned. It also takes away some of the reinvestment risk and what we call the opportunity cost. When you lock in at 7 years at 4 and 4.8 or 4.25, if interest rates have gone up, sometimes you can lose out on another 1.2 or 2.2 compounded interest. So laddering for longer terms provides you with a little better modality in the form of, I wouldn't call it dollar cost averaging, but it's kind of the same theme or the same idea. So some of the objections that you might see, and a lot of people, they're going to revert to what they know. Sometimes you have to educate the client a little bit, kind of broaden their expanse in the universe of insurance so that they have a good idea of what they could get at a higher benefit. I'll just buy a CD. Look, CDs are great short-term options. You need a year and you want a very predictable rate, nothing wrong with CD. They're insured up to $250,000. If you're going to put $250,000 in a CD, you're not going to have any surprises. But typically the MYGA is going to pay a little bit higher, and it's going to give you better liquidity provisions. If you run in a jam, you need to pull 10%. The MYGA's got your back on that concern, whereas a CD, you're typically going to be locked up at minimum for a year. So what if rates increase? Well, a MYGA ladder, you can take advantage of those higher rates. With CDs, what you see is what you get at current assumption rate. You're not going to be able to buy future CDs based off of what they think interest rates will be. You'll buy them at the current assumption. MYGAs, when you ladder them, they give you an opportunity to diversify against those interest rates and catch higher locking interest rates in at a higher nominal coupon. I don't want my money locked up. Well, with the CD, at minimum, you are locked up for a year. The MYGA, you do have the flexibility of those free withdrawals. You have some liquidity provisions. You also can add on riders for, nursing home care or LTC that would give you qualifying conditions to where if you get hurt, you get sick, something happens, they will either pay you, some sort of payment for the rest of your life, or they will allow you some free liquidity on a circumstantial level based on your situation. You won't have that with the CD in most cases. Another thing, what if I die? Well, with the CD, if you pass away, that asset is probably going to be added to your estate. It is going to go through probate court or judge. Your beneficiaries are waiting, producing documentation, and doing what they need to do to be able to inherit that legacy you sent. With the MYGA or the FIA or annuity products, you can assign a beneficiary that completely bypasses probate. All they need is a death certificate to make a claim, and they are going to get every penny of the money that you put in for premium, and it will go to them in the form of a death benefit, bypassing probate and all the rigmarole altogether. And that's one of the strengths of annuities when we're doing legacy planning. So here's a quick case study. I'll try to keep it fairly concise. Situation: you got $500,000 in CDs that are maturing. Hopefully they bought at least 2 CDs and were insured for the full amount. If they bought one, they were only insured up to $250,000. The client's $500,000 is in a 5-year CD. It was set up to mature in 60 days. The CD had a 1.4 APY. Market rates were rising. Client wanted better returns, but also principal protection, and they're concerned about locking their money up long-term with no liquidity provisions. How would the advisor position the MYGA? Well, the advisor reviewed the client's goals and highlighted how a multi-year guaranteed annuity could deliver more value, which is often the case. You're locked in at a higher guaranteed rate with no market risk. You're provided the safety and security of 10% free withdrawals for liquidity provisions, included a nursing home waiver for added protection, and presented a laddered strategy to benefit from future rate increases. Why the client moved their assets? Well, the client saw the MYGA as a smarter solution for safety, flexibility, and growth. They got a significantly higher guaranteed rate than the CD. They had access to the funds if needed without penalty within that 10% limit. They had peace of mind and added living benefits, and confidence in the advisor's plan and carrier strength that that carrier is going to keep their word on the promises and the contract that they give you with that multi-year guaranteed annuity. So this guy moved the full $500,000 into a 5-year MYGA, ended up tranching that rate on CD at 4.35 APY. Still have the benefit and flexibility of 10% free withdrawals annually, a nursing home waiver included, or if they lose one or two or three ADLs, activities of daily living, they can qualify for either extra payments or enhanced liquidity. It's stronger returns with principal protection. The client is happy and confident and are already referring business because they know that their retirement is not going to get thrown off track by any major market volatility. So some of the key takeaways with MYGAs and FIAs: we can use laddered strategies. We can highlight and access living benefits. We can match and tailor an outcome to a specific interest rate to match their solution or goals. And it's fairly easy to educate them and position confidently because products are fairly simple, guaranteed products that are easy to understand and easy to place. We do review them regularly with the MYGA. What you see is what you're going to get. So, that annual review is not going to be a big surprise. You're going to see the compounding that you were told you were going to get at the front end of that contract. So the best practices here are: lead with who has the most competitive interest rates, who are some of the strongest, carriers and insurers backed by good balance sheets and strong fundamentals. They show the big picture in your planning, and you're able to address those objections, usually to those CD investors or people in money instruments, with some confidence. We're usually going to be able to pay a better rate and give you some of the same guarantees and not throw you any surprises. And it's fairly easy to do the annual reviews and documentation and follow up on these because, like I said, what you get promised on the front end is going to be what you see from MYGA. The cross-selling opportunities are when you pair MYGAs with life insurance. A lot of times it's maybe if there's a certain level of coverage you need to cover your estate, you can buy a MYGA and you can even set it to an annuitized modality where it will pay your insurance premiums, or it will run in conjunction with an insurance product, produce some income and some coverage. They are absolutely, bar none, one of the best tools in our suitcase to use for income planning. They don't throw out any surprises. You're going to know what you're going to get on a monthly, quarterly, or annual basis, and they are just a godsend when it comes to retirement withdrawal phases. They run in non-qualified and qualified modalities, so they are great for IRA rollovers, and they are a very, very useful tool in your tool belt for estate and legacy planning. So here at Penny, there's a few things we handle. We handle retirement solutions, health insurance, life insurance, annuities, long-term disability. We also do personal and commercial lines, and we help out and help structure out some group plans, SERPs, etc. All of these things are kind of in our wheelhouse. If you have any questions about any of these individual sections of financial planning, we are more than happy to sit down and talk to you on the Zoom. Here's my information. If you need to get a hold of me, you have some questions about MYGAs or the annuity space, I'm more than happy. I'm available from 8 to 5 Central Standard Time, any days the markets are open and barring federal holidays. My number is 325-656-0024, and you can reach me at cking@pennyinsurance.com. I do invite you to join our next webinar, and if I can illuminate or show you the value of some of these products, I am more than happy to do so. Feel free to give me a call. That's what I'm here for. I want to thank you guys for coming to our presentation today, and we look forward to talking to you about some of these products in the future. Thank you.